I want to start today with a bit of a psychological experiment for you listening.
Okay, I like where this is going. Let's do it.
Yeah. So I'm your host, and if I ask you, the listener, to just close your eyes and visualize the act of saving money, what is the actual image that hits your brain? Like, be honest with yourself.
And I'm the expert guiding us through the research today, and I can tell you if we're going by the standard cultural script, it's probably pretty bleak.
Right. It's usually this image of subtraction.
Hmm.
It's saying no to the dinner reservation, or it's driving that sedan with the rattling muffler,
Yep. Yeah.
or it's the classic trope, right? Eating cold beans out of a can tonight so you can maybe, possibly afford a decent retirement in like 2050.
It is the literal definition of deprivation.
Yeah.
You are essentially volunteering for unhappiness right now in exchange for security later. That's the default narrative we all have. Saving is a chore.
Exactly.
Yeah.
And that is exactly why it feels like such a heavy lift for so many people. It just feels like a punishment. But we have a stack of research today that is going to completely dismantle that view. We're doing a deep dive into a really fascinating concept from a piece called The Psychology of Saving as an Optionality Engine.
It's a fantastic framework because it argues that if you view saving as a defensive move, like as just playing it safe, you are fundamentally misunderstanding the mechanics of wealth. The source material here argues that saving is actually an aggressive, offensive financial strategy.
I really love that shift. Offensive.
Yeah.
It's not about losing joy today. It's about buying power. So our mission for this deep dive is to walk through this research and help you stop dreading that transfer to your savings account and start seeing it as the ultimate power move.
Right.
But to get there, I think we have to start with the first core concept in the text, which is the primary controllable edge.
The edge. This is the holy grail in finance. I mean, hedge funds spend billions trying to find an edge.
Oh, yeah.
They're looking for an information advantage or a faster trading algorithm or, buying satellite imagery of retail parking lots.
Yeah. Usually when we talk about an edge, we're talking about finding the next NVIDIA before everyone else does. We're talking about market alpha.
And that is the trap. The source makes this really compelling distinction between market alpha, which is trying to beat the market, and what we might call behavioral alpha.
Okay, unpack that for us.
Well, look at the variables an average investor obsesses over. We worry about what the Federal Reserve is going to do with interest rates next month. We worry about GDP reports.
Right.
We worry about whether a tech bubble is bursting.
And most of all, I think we worry about the behavior of other investors, which is terrifying.
It is.
Because you have absolutely zero control over any of that. You're effectively strapping yourself into a roller coaster that is being driven by strangers who are also panicking.
Precisely. You are outsourcing your financial outcome to external forces. But the source argues that you have one variable, and really only one that is fully within your jurisdiction, and that is your savings rate. That is your actual edge.
Okay, I have to play devil's advocate here for a second.
Go for it.
Because that sounds almost too simple. Can a savings rate really compete with stock-picking genius? Like, if I'm saving 10% but the market crashes, am I not still in trouble?
The math on this is actually shocking. The source provides some modeling that shows how powerful the gap is. And by the gap, I mean the space between what you earn and what you spend.
Okay.
If you have a high savings rate, you are mathematically less dependent on market returns to hit your wealth targets.
So if I'm only saving, say, 5% of my income, I kind of need the market to tear it up to get wealthy.
Yeah.
I need that 10 or 12% annualized return just to catch up.
Right. You are fragile in that scenario. You need the external world to cooperate with you perfectly. But if you are saving 30 or 40% of your income, you can actually endure a decade of flat market returns and still end up wealthy. You are feeding the machine so aggressively that the market's performance becomes a secondary variable, not the primary one.
That is a massive psychological release. It takes the pressure off of me having to be Warren Buffett.
Yeah.
I don't need to find the needle in the haystack.
Yeah.
I just need to keep buying the haystack.
Exactly. And this leads to a total reframe of frugality. In the beans in a can model we talked about, frugality is suffering.
Yeah.
But in the optionality engine model, frugality is an instant risk-free return on your capital.
Walk me through the risk-free return part, because usually when I hear risk-free, I think of like treasury bonds yielding maybe 4%.
Think about it this way. If you put money into the S&P 500, you are hoping for an 8% return.
Right.
But you are accepting volatility and risk to get it. However, if you optimize your lifestyle to cut your structural expenses by that same amount, you have immediately increased your net wealth by that amount. You didn't have to wait a year to see if the stock went up. You widened the gap immediately.
And you get to keep that return every single month moving forward.
Correct. And the source really emphasizes the stabilizing effect of this. We all know the market is cyclical. It crashes, it corrects. When that happens, the investor relying purely on returns feels completely helpless.
Right.
They're glued to the screen, panic selling, feeling like a victim of the economy.
Whereas the aggressive saver?
The aggressive saver looks at a market downturn and just shrugs.
Yeah.
Their primary lever, which is their behavior, is still working. They're still feeding the machine. In fact, they might even be happy because their fresh capital is buying assets on sale. It puts the driver's wheel entirely back in your hands.
I want to pivot to the second section of the research because this part actually challenged me a bit when I read it. The source discusses the save, just save philosophy.
Yes. This is where the source pushes back pretty hard against standard financial advice.
Because usually the advice we hear is hyper-specific, right? Like SMART goals. You save for a house. You save for a Tesla. You save for that trip to Bali. You need a target to stay motivated. But this text says maybe not. Which sounds like a recipe for losing focus to me.
It does sound counterintuitive, but the source argues that specific goals can actually be a liability. The core argument here is that humans are just terrible at forecasting their future selves.
Oh, that is painfully true.
Right.
If I look at what I wanted 5 years ago versus what I want now, there's very little overlap. 5 years ago, I wanted a louder car, and now I just want a quieter house.
Exactly. Life is path-dependent, and it's noisy. We tend to assume our lives will follow this linear trajectory, junior associate, senior associate, vice president, retire.
Right.
But in reality, life is messy. Health events happen, industries collapse. You might discover a completely new passion at 35. If all your money is locked into the house fund, you lose all your agility.
So the argument is that by assigning every single dollar a specific job, you're actually restricting what that dollar can do for you when the plan inevitably changes.
Right. The source compares generic savings to uncommitted capital in a venture capital fund, or they use the term dry powder.
I like the dry powder analogy. It sounds very tactical.
It is tactical. In business, having cash on the balance sheet is highly valuable because it allows a company to pivot when the world changes. Your personal finances are no different. You aren't saving for a thing. You are saving for a hedge against the unknown.
And the source points out that the biggest inflection points in our lives are usually unplanned.
Both the threats and the opportunities. We always focus on the threats, right? The transmission blowing up, the roof leaking.
Yeah.
But think about the opportunities.
Like what? Give me a concrete example of an opportunity you can't take without this dry powder.
Say a dream job opens up at a nonprofit or maybe a high-growth startup. It's work you are deeply passionate about, but it pays 30% less than your current corporate gig.
Oh, wow. Yeah, if you were living paycheck to paycheck, or if all your savings are strictly earmarked for, like, a kitchen renovation, you just can't take that job.
Sure.
You literally cannot afford the opportunity. You're handcuffed to your current salary. Or maybe it's a chance to move to a new city or buy into a business partnership suddenly. If you view your savings as the optionality engine, that money isn't kitchen money. It is freedom to pivot money.
That really changes the emotional texture of spending, doesn't it?
It really does.
It's not, I can't buy this coffee because I need a house in 2030. It's, I'm not buying this coffee because I am buying a mystery box of opportunities for my future self.
And that leads us directly to the third and I think the most powerful section of the deep dive.
Let's get into it.
What is the real payoff? If we aren't just piling up gold coins like a dragon, what are we actually buying?
The source is crystal clear on this point. The highest form of wealth isn't a Ferrari. It's the ability to wake up in the morning and say, I can do whatever I want today. Money's highest use is control over time, not the consumption of goods.
This is the strongest psychological reframe in the entire document.
Yeah.
We are so conditioned to measure wealth by what we can display. But the source breaks down 3 invisible pillars of freedom that this optionality engine buys you.
Let's hit those. Pillar number 1 is flexibility.
This is the power to say no. And honestly, that is a superpower. If your savings are thin, you have to say yes to everything. You have to say yes to the toxic boss who emails you at 11 p.m. You have to say yes to the client who treats you like dirt.
The source calls this being paycheck desperate.
It's a heavy phrase.
It really is.
Being paycheck desperate means you have surrendered your autonomy. You are operating from a position of total weakness. But when you have that buffer, that dry powder we talked about, you can look at a bad situation and say, you know what, this isn't worth my sanity.
It's having walkaway leverage in every single negotiation of your life. Even if you don't quit, just knowing you could changes the power dynamic in the room entirely.
Absolutely. And that brings us to the second pillar, which is time freedom.
Now, this goes beyond just retiring early,
Right?
because not everyone wants to stop working at 40.
Exactly. It's about buying back your calendar in smaller chunks. Maybe it's negotiating a 4-day work week because you can afford the 20% pay cut.
Oh, that's a great example.
Or maybe it's taking a 6-month sabbatical to write a book or travel. Or simply knowing you can take a month off between jobs rather than rushing into the first mediocre offer you get.
Which connects to the third pillar, emotional safety.
This is the reduction of background anxiety. You know that low-level hum of stress that keeps you up at 3 a.m.?
Oh, yeah. What if the car breaks? What if I get sick?
Yeah.
What if the quarterly numbers are bad?
It's like a computer program running in the background, just eating up all your RAM. You don't even realize it's slowing you down until it's finally gone.
Exactly. When you have a fully funded optionality engine, problems undergo a phase change. They stop being crises and start becoming inconveniences.
I love that distinction. Think about it. If you have $50 in the bank and your transmission blows, that is a full-blown crisis.
It really is.
It might cost you your job because you can't get to work. It spirals into credit card debt.
But if you have $20,000 in the bank, it's just annoying.
Right. You have to call the mechanic. You have to take an Uber for a few days. But your heart rate doesn't spike. You don't lose sleep. And that fundamentally changes how you show up in the world. You aren't operating from a place of fear. You parent better. You work better.
So knowing all this, knowing that we are buying freedom, not just numbers, the source suggests a specific question we should ask ourselves at the register. Instead of asking, can I afford this? What should we be asking?
You should ask, is this purchase better than slightly more freedom later?
That is a brutal question.
Yeah.
Is this sandwich better than my autonomy?
Well, look, sometimes the answer is yes.
True.
Sometimes you really need the sandwich. Sometimes you need the vacation to recharge. The point isn't to live like a monk. The point is to make the trade-off explicit. When you realize that you are trading a piece of your future, no power for a consumer good, you might decide the good isn't worth it. But either way, you own the decision.
Okay, so we've got the philosophy, we've got the motivation, but let's land the plane here. Section 4 is the habit system. We need to get tactical. How do we actually operationalize this? Because willpower runs out eventually.
Right, we need systems in place. The source gives us some very tactical KPIs, key performance indicators. If you treat your personal finances like a business, your savings rate is your core metric.
And they don't pull punches on the target here.
No, they don't. The suggestion is to aim for a savings rate of 20 to 40%.
Whoa. Okay, 20 to 40%. The average savings rate in this country hangs around 5 to 7%. Getting to 40% sounds like climbing Everest for most people listening. How do we even approach that without making life miserable?
You're right, it's a steep climb, and you don't get there overnight. But the source offers a mechanism called the raise rule, which is arguably the most effective way to get there without feeling the pinch.
Break that down for us.
The rule is simple. When you get a raise, a bonus, or a tax refund, you decide immediately before the money ever hits your checking account what the split is.
Because if you don't decide...
Lifestyle creep is like a gas. It expands to fill the available space.
Yeah.
It's almost automatic. You get a $5,000 raise, and suddenly you're buying nicer wine, you're ordering the premium cable package, you're upgrading the car lease. 6 months later, you feel exactly as broke as you did before the raise.
It's the golden handcuffs tightening. You earn more, so you spend more, so you need to keep earning more.
Exactly. The raise rule breaks that cycle completely. The source suggests a 50-50 split as a baseline. You get a $5,000 raise. Awesome. Put $2,500 directly into the optionality engine, automate it so you never even see it. Then use the other $2,500 to enjoy life. You still get a lifestyle upgrade, but you are also systematically widening your edge.
I like that a lot. It feels sustainable. You aren't punishing yourself for doing well at work. You're just taxing yourself first. Now, what about the other side of the coin? The temptation. The source mentions an impulse check.
Ah, yes. This is for when your cousin calls you up and says, hey, put everything into this new crypto coin. Or you get a hot stock tip from a buddy at the gym.
The get-rich-quick impulse. It's tempting because saving 40% is boring. Crypto is exciting.
It is exciting, but it's dangerous. The source advises asking a sobering question when that greed kicks in. Would I be better off just increasing my savings rate by 1% instead?
It goes right back to the edge. Betting on the coin is betting on luck. Increasing your savings rate is betting on math.
Exactly. One is gambling, the other is engineering. And usually the math wins.
Finally, there's a note here about visualization. Because let's be real, looking at a high-yield savings account is boring. It doesn't give you the dopamine hit of a volatile stock portfolio going up. How do we keep the brain engaged in this?
It can be boring if you just see digits on a screen. The source suggests changing the unit of measurement. Stop tracking dollars. Start tracking years of freedom or months of runway.
So instead of seeing $15,000, you see 4 months where I don't have to answer to anyone.
Yes. You can even rename the accounts in your banking app. Don't call it savings. Call it the Opportunity Fund or the Freedom Fund. Visually link that balance to a concrete store of future choices.
It's like psychological judo. You're tricking your brain into seeing the money as potential energy rather than just static cash sitting there.
And that is crucial because, as we said at the start, saving is usually framed as a loss. By renaming it and measuring it in time, you frame it as a gain.
This has been a really refreshing take. I think for a long time, I've viewed saving as the thing I have to do, like eating my vegetables or flossing.
Yeah.
But this flips it to something I get to do to build armor for the future.
That's the big takeaway here. You have a superpower, and it's not your ability to predict inflation or pick stocks. It's the gap. By widening the gap between what you earn and what you spend, you are building a hedge against a chaotic world.
And the payoff isn't stuff. The payoff is autonomy. It's the ability to handle whatever life throws at you, good or bad, on your own terms.
Correct.
I want to leave the listener with one final thought from you. Something for them to mull over as they go about their day.
Sure. I want you to imagine your bank account for a second. But don't picture numbers. I want you to picture a physical stockpile of the word no.
Oh, wow.
Every dollar you add to that pile is another no you can use later. A no to a commute you hate. A no to a boss who disrespects you. A no to missing your kid's soccer game because of an arbitrary deadline. If you visualize your savings as a stockpile of no's, how would that change what you buy today? Would that sweater or that new gadget really be worth burning one of your no's?
That is a powerful image. A stockpile of no's. I'm definitely going to be thinking about that one. Thanks for listening to this deep dive. We'll see you next time.